Greetings, this is Manu Walia from Continuum Global Asset Management. Today is May 27th. Our last recording on YouTube was on March 17th. At that point, the markets had gone down between 25 and 30%. And fortunately and luckily, we repeated and recommended that people buy stocks. Again, it wasn't a recommendation, but a prediction slash projection based on certain fundamentals, but more importantly, investor psychology. We believed at that time that the 30% or so a correction in the market was overdone, and I did get some hate mail on that. But I mean, I understand everyone's perspective. You know, that's what makes the markets. Since then, the markets have gained over 30%, and like I said, you call it lucky, you call it good projections, whatever it is. Without further intellectualizing it, I'd like to tell you in retrospect what I think or why I think that the market went up. And it was really not for the reasons that I had initially thought that the markets were going up. So here are certain charts I'd like to show the viewers. This is a chart of the recessions that have happened in the United States since the 1980s. I'm sorry, 1870s. And I'd like the viewers to not concentrate on the numbers, but just to sort of view these gray bars since the 1870s. There's a very distinct pattern here that these bars were bigger and broader back in the 1870s and the early 1900s, and since then you're watching that the pattern is showing a decrease in the breadth and the length of these recessions, with an exception of 2008 and 9, which was a pretty bad recession that we faced, and the big one, which is the 1920s, that we just, that was one of the worst depressions that we saw. So if you took those out, you will see that these bars are getting thinner and smaller. Why is that? The reason that is apparent is because the intervention and the creation of the federal government, the FOMC. The FOMC was formed back in the early 1900s to really look at two things: inflation and unemployment. Now, this chart clearly shows that the rates that the Federal Open Market Committee or the federal government sets has been going down. Just to take a step back and say, the rates that the federal government puts in the market are directly related to the cost of capital for businesses, small businesses, real estate, and what have you. So the lower the rates, the lower our cost of capital. So if you're a small business and you wanted to borrow money, you'd obviously like to borrow it at a lower rate. That has a direct relationship with inflation, but as we've seen over the last 3 or 4 decades, inflation has stayed low, and therefore the federal government has had an easier way or an easier time to keep the interest rates low. If you look at this chart clearly shows a relationship between the Fed fund rates, which is the rates the federal government sets so that bigger banks can borrow money and further lend it to people who need it: small businesses, large businesses, real estate investors, and so on and so forth. Again, without getting into the minutia of the different numbers here, I'd like you to just focus on these two numbers. During the times that the federal government had lowered or are in the cycle of lowering rates, the Standard & Poor 500 index has gone up about 19% on an average. On the contrary, when the federal government has been tightening rates, the market has only gone up by 5.5%. So what that means is that there is obviously a direct relationship between how the federal government plays or has a play on their monetary policy. Everybody knows that, but the evidence is right there. Lastly, what I wanted to show is that even though the markets have gone up by almost 30% since the late March, what do we think the market's going to do going forward? So we decided that we'd like to show you a market projection model that we have created on a proprietary basis with about 16 or 17 variables that we follow. And off of those variables, there's about 6 variables that we believe are very, very important. As you can see on the screen, these are the earnings for the S&P 500, the price earnings ratio, the bond rate. Unfortunately, the table shows that it's 0.07% or 7 bips, which is incorrect. Just the way the model uses it, we had to put an extra zero in it, but it really is 70 basis points. So right now the 10-year Treasury bond is trading between 70 and 80 bips, somewhere around there. The inflation rate is 2%, unemployment at 10% because we believe that the markets, actually right now the unemployment rate is much higher, but we are looking at a 10%, and the volatility index at 28%, 28 or so. So if we look at these 6 variables, they explain almost 93 to 94% of the movement of the S&P 500 over the last 4 decades. So we really believe in this model, and of course every model comes with its own error rates, which we will show. So if we decided, or if we as investors think that everything in the market is okay, and the corona or the COVID-19 does not have any impact on the earnings, then we're going to look at the earnings of 2019, which were about $162 for the S&P 500 companies. If we put that into our model, we see that the markets are currently fairly valued. So at 162 and all the other variables that I showed, the model shows a projection of 3,038, and today the market's closed, I believe, around 3,018. So that's a flat for the market. In other words, if we did not see COVID-19 and we had no deceleration in the economy, the markets have come back up to a fairly valued, so we don't see a big upside in the market right now. We all know that there's about 30 to 33 million people who are unemployed, and obviously they will come back into the market soon, but how soon we don't know. If we took a 10% deceleration in the S&P 500 earnings, we see that the model suggests or guides a 5 to 6% decline or a small correction. If we move this one step to a 15% decline in the S&P 500, we see that the market can go down 9%. Of course, by no means am I saying that the markets will go down 9% right away. What I am saying is that I'm pretty convinced that with the 33 million people unemployed, the unemployment rate will be higher than 10%. This was worse than what we experienced in 2008, 2009. In addition to that, we have so much debt in the market, at some point in time we'll have to pay that back. And I don't even understand the ramifications of that, but it is bad. It can't be good. In addition to that, there are so many industries, specifically travel, transportation, leisure, restaurants, that will be hurt and will not come back online, in a blink of an eye. There are other sectors which will do well. So even though I cannot and will not recommend online for customers or investors to do one way or another, because every individual client is different and every individual investor is different. But I think it makes a lot of sense to think in terms of caution at this point in time. We were gung-ho in March, markets have come back up. Again, the fundamentals have not improved in that short time period. So if somebody asked me, I would lean in and take some profits, raise 10 to 15% in cash, maybe more, depending upon where you are, and not just be gung-ho and think that the markets are going to continue to make new highs. Then again, I've been a contrarian back then, I'm a contrarian now, and that's the way my fabric is. And I appreciate you guys watching this clip. Once again, thank you. And if you have more questions, feel free to give me a call or contact me through Continuum Global's website, which is cgamadvisor.com. Again, thanks for watching and have a great investing day, year, month, whatever you're doing.